The stock market was supposed to be in trouble. A major conflict had erupted in the Middle East. Oil supply fears were spreading across global markets. Investors were warning about economic shocks, rising inflation, and even the possibility of a recession. Then something unexpected happened. A ceasefire was announced, and almost instantly the stock market exploded higher. The S&P 500 surged, the Nasdaq jumped nearly 3%, the Dow gained more than 1,000 points. Within weeks, stocks were back near record highs. Financial media quickly came up with an explanation. They called it a relief rally. According to the headlines, investors were simply celebrating peace. But here's the problem: the conflict wasn't really over. Reports showed that disruptions in key shipping routes were still ongoing. Many of the risks that investors had been worried about hadn't disappeared at all. So, if the fundamentals hadn't dramatically improved, why did the market rally so aggressively? The answer has very little to do with world peace and a lot more to do with how modern financial markets actually work. To understand what happened, we need to go back to what Wall Street looked like before the rally began. In the weeks leading up to the ceasefire, fear was everywhere. Hedge funds were aggressively selling stocks. Many professional investors believed the conflict could trigger a major oil shock. If oil prices exploded higher, inflation could return. Central banks might delay interest rate cuts. Economic growth could slow. As a result, investors piled into bearish trades. They were betting that stock prices would fall. Some of the largest hedge funds on Wall Street built enormous short positions. In simple terms, they were betting against the market. And that's where the story gets interesting. Because when everyone is positioned for the same outcome, it doesn't take much to create chaos. The moment the ceasefire announcement hit the news, markets moved higher. At first, the move seemed reasonable, but then stocks kept rising and rising and rising. Soon, investors who had bet against the market found themselves in trouble. This is where something called a short squeeze comes into play. When traders short a stock, they borrow shares and sell them, hoping to buy them back later at a lower price. But if prices rise instead of fall, those traders start losing money. And the higher prices go, the bigger those losses become. Eventually, many of those traders are forced to close their positions. To do that, they must buy back the shares they originally sold. That buying pushes prices even higher, which forces even more short sellers to buy, which pushes prices up again. It's a feedback loop, and that's exactly what happened. What started as a normal rally quickly turned into a wave of forced buying. But the short squeeze was only the first domino. The second domino was algorithms. Today's markets are heavily influenced by computer driven trading systems. Unlike human investors, these systems don't care about politics, economic forecasts, or news headlines. They follow rules. When prices fall, many algorithms sell. When prices rise, they buy. As stocks climbed after the ceasefire announcement, many of these systems automatically switched from bearish positions to bullish positions. Suddenly, billions of dollars began flowing back into equities. Not because analysts changed their minds, not because investors became optimistic, but because computer models were programmed to follow the trend. Then came the third domino, the options market. Most people never think about options trading, but it has become one of the most powerful forces in modern markets. When traders buy large numbers of call options, market makers often need to buy the underlying stocks as protection. This process is called hedging. And during strong rallies, that hedging activity can create even more buying pressure. So now three powerful forces were all pushing in the same direction. Short sellers were buying, algorithms were buying, options dealers were buying. The result was an explosive rally. And perhaps the most fascinating part is that we've seen this movie before. Similar events have happened repeatedly over the past decade. Different headlines, different catalysts, but the same underlying mechanics. Markets today operate very differently than they did 20 years ago. Back then, stock prices were influenced primarily by human investors studying companies, analyzing earnings, and evaluating long term value. Today, a huge percentage of money is controlled by passive index funds. These funds don't analyze businesses, they simply buy whatever is inside the index. The larger a company becomes, the more of it they buy. At the same time, algorithmic trading has grown dramatically. Options trading has exploded, and leverage across the financial system has increased. As a result, markets have become more reactive than ever before. Price movements themselves often create even larger price movements. That's why markets can sometimes rise during bad news and fall during good news. The explanation isn't always found in the headlines. Sometimes the real story is hidden underneath the surface. It's hidden in positioning, it's hidden in leverage, it's hidden in algorithms, and it's hidden in the mechanics of the market itself. The ceasefire may have been the spark, but the massive rally that followed wasn't simply a celebration of peace. It was the result of a modern market structure where forced buying, automated trading, and options activity can sometimes matter more than the actual news. And once you understand that, many of the market's most confusing moves suddenly start making a lot more sense.